The latest rate rise by the RBA came as a surprise to many, and it's going to hurt. It's going to especially cause so many people who are already in financial distress to be stretched even further. But the question then is, what does this mean for property prices? And it's probably not what most people think. Hi, it's Nero here. And when it comes to property prices right now, you're going to be in one of two camps. You're either going to be someone who thinks that property prices are going to fall because interest rates are so high, or you're someone who's starting to doubt that because of what you're seeing out there in the marketplace. So let's begin by looking at the 3 reasons why some people think property prices are going to fall. And the thing is, each of their reasons is actually true. Number 1. We've had 11 interest rate rises in the last 12 months. This is the fastest speed of rate hiking in recent memory, and so many people are in financial distress. Now that's a fact that you can't dispute. Number 2, as a result of these 11 interest rate rises, borrowing capacities have been smashed. Most people's borrowing capacities have dropped by 30% or more. So that means that 12 months ago, before these interest rate rises began, if you could afford a property price of $1 million, today you'd be struggling to buy something for $700,000. So a lot of people simply can't afford the properties that they want to live in, even though property prices have fallen in many of our major centers, which is true. And then number 3 is that in the past, property prices did not recover. They did not start rising again until interest rates were cut. This is also true, as you can see from this chart. Now, this chart is from AMP Capital's chief economist, Shane Oliver. And what you can see is that if you look at these purple ovals here in this chart, that's when property prices started to rise. But they only started to rise once interest rates stopped being increased and in fact started to be cut. So with more people in financial distress, borrowing capacities dropping, and history on their side, you really can't blame some people for thinking that property prices will drop again. But if that was the case, then you would start to see auction clearance rates dropping, people not turning up to auctions or open homes, real estate agents going broke, and you would see headlines talking about how properties are starting to sell for record lows. Is that what's happening though? No, not at all. Have a look at this. House prices power past RBA rate hike. This month's 0.25% interest rate hike from the Reserve Bank of Australia, RBA, has failed to slow the housing market, with the nation's final auctions clearance rate rising to 66.9% last weekend. This was the strongest result since late February 2022, which was at 70.9%. Now, mind you, February 2022 was before the interest rate rises began. The article then goes on to say, the rebound in auction clearance rates is being matched by home prices, which also rose strongly despite the RBA's latest rate hike. In the week ending 11th of May, which mind you was after the last rate rise, CoreLogic's daily dwelling values index rose by 0.31% across the 5 major capital city markets. Now, again, that might not sound like much until you realize this. This was the strongest weekly price increase since mid-October 2021. And if you remember how the market was in mid-October 2021, it was a boom market. The article then goes on to say, since bottoming on 7th of February 2023, dwelling values at the 5-city aggregate level have rebounded by 2.1%. And what you can see here is this chart. The red line here shows when the RBA began tightening interest rates. We know that property prices then started to fall, but have started to rebound quite strongly, with Sydney and Brisbane leading the way. And we're now starting to see articles again about people paying record prices for property. Here's just one example. Young couple drop $5.75 million on Coogee Fixer Upper. A young couple dropped $5.75 million on a 4-bedroom fixer-upper in Coogee, just a short walk from Coogee Beach. They were one of 4 buyers, all young homeowners, registered to bid on the tightly held home, which was initially guided at $4.6 million, but revised up to $5 million after a pre-auction offer of the same amount, and then ended up selling for $5.75 million. So to me, this almost seems like we're at the start of the next property boom. But of course, the skeptics will call this a dead cat bounce. I've spoken about this in the past, but the term dead cat bounce doesn't apply to the property market. It comes from the share market. And the reason why it doesn't apply is because property is not a liquid vehicle. Let me explain. In the share market, dead cat bounce means that when share prices drop, people think it's reached the bottom, they go in there to try and buy the shares, share prices rise briefly, and then, oh my goodness, something comes to light, and they realize that the share market is going to drop even further, and the price of that share is going to drop even further. People start selling, okay? Hence a dead cat bounce, a temporary rise before the ongoing fall continues. But that doesn't apply to property prices, right? Because when you buy a property today, you can't sell it tomorrow, okay? It's going to cost too much with transaction costs, all right? And that's why when there's a shift in direction in property prices, it's a sustained shift. So there is no dead cat bounce when it comes to the property market. So then if property prices are rising and these price rises are here to stay, the question is, how can this be happening in the first place? I mean, what's driving property prices to rise? How can property prices be rising in the face of rising interest rates? Well, here's the answer. There simply aren't enough properties in Australia for people who want to live here. And sadly, that crisis is actually getting worse in not one way, but in 2 ways. Firstly, remember how I mentioned earlier on that people's borrowing capacities have dropped by 30%? Well, that has to affect the market in some way, right? And it has, but it's actually only affecting a particular segment of the property market. Have a look at this. New housing approvals plunged to 2.5-year low. New housing approvals fell to the lowest level in almost 2.5 years in March, triggered by a surge in borrowing and construction costs that depressed new sales and projects. New dwelling approvals in the 12 months through March fell 15% to 180,893 from the year earlier period, the Australian Bureau of Statistics said on Monday. It was the weakest yearly result since October 2020. What that means in simple English is because people's borrowing capacities have reduced significantly, plus construction costs have increased, fewer and fewer people are willing to buy a property where there's a construction phase. In other words, they're unwilling to buy a brand new property via a developer or builder that needs to be built. So it's builders and developers who are bearing the brunt of these higher interest rates. And that's reducing the supply to record levels at a time when we need to be increasing supply. And why do I say that? It's because we've got migration coming in right now at record levels, which is only going to put more pressure on rents and property prices. A big change is looming for Australians, with already frustrated renters expected to be hit the hardest. More than 700,000 people are expected to move to Australia by the end of next year, adding to the squeeze on the nation's already very tight rental market. The Albanese government's second budget, handed down on Tuesday night, is forecasting a temporary migration boom, reflecting a one-off catch-up after the COVID-19 pandemic. At the same time, budget papers confirm rental demand has increased sharply, in part because of an influx of new tenants who have moved here following the reopening of Australia's international borders. So these rate rises are going to have a very unexpected impact on the property market. Yes, sadly, they will affect some mortgage holders who will be forced to sell their property even if they don't want to. But because there are more buyers than properties available for sale, they're not going to have to fire sell their property and crash the market. The odds are they'll get a very, very good price. But ultimately, that's the key takeaway message. More buyers than properties available for sale. More demand than supply. Strong demand in the rental market as well, which is tightening that sector, increasing rental returns. So even though interest rates are rising, we're going to have this very unique situation where you could buy property in certain areas where prices rise and rents rise. And I'm not sure that's ever happened in our history. But as I said, that's not going to happen everywhere. So if you want help trying to work out where these areas are, then click the link in the description to get for free the audio version and a digital copy of my book. I'll see you next time.